Welcome. In this video, we're going to be doing some transactional analysis, and we're going to be using exercise 2-1 for this demonstration problem. In class, we'll be taking this same data and we will be putting them into journal form and then posting to T accounts, which represent the general ledger, and then working into an unadjusted trial balance. So let's begin by looking at the first transaction where we issued shares of common stock, and this represents paid-in capital, and the owners are going to invest $300,000 in cash. Well, the first thing to understand is that this $300,000 does not represent revenue. We don't sell our own stock to our owners. We issue the shares. So we're going to be receiving cash, which is an asset, and we're going to be increasing our assets by $300,000. Well, we don't owe this money to our owners. Instead, this is what we call paid-in capital. So in this transaction, we have increased assets by $300,000 and equity by $300,000 because these are on opposite sides of the equal sign in our accounting equation. Our entry is in balance. Next, we purchase equipment at a cost of $40,000. We do this by paying some cash and then taking out a loan for the rest. So first we purchase the equipment. We're going to use the historical cost of $40,000 in our accounting records. So we increase assets by $40,000. Well, we paid some cash for that, $10,000. So we need to subtract out $10,000 in cash. The balance, $30,000, is a debt that we owe. The difference between the invoice price of the equipment and the cash we paid is a note we're going to sign for $30,000. So in this transaction, three things are going on. We have equipment, we have cash, and we have a debt. But our entry will balance because assets go up by $40,000, reduced by 10, a net amount of 30, and our liabilities will increase by 30. So on the asset side, we have an increase of 30, and on the liability equity side, we have an increase of 30. Right, next we purchased some inventory that we plan on selling. The inventory had a cost of $90,000. So at this point, when we have not sold it, it is not an expense yet. Instead, this $90,000 forms our merchandise inventory, and inventory is an asset. So we will increase the asset by $90,000. Now, we did not pay cash for this yet. We know that by the term on account, which means we owe this to our vendor supplier. So again, we have assets going up by $90,000 and liabilities by $90,000. The next statement, the company uses the perpetual inventory system, is important because if you remember back to your earlier accounting classes, when we use the perpetual inventory system, we're going to recognize both the asset that we receive from the sale, which occurs in the next transaction. Here we sell on credit. So again, even though we're not receiving cash at this point, we have this intangible asset that we call accounts receivable that forms this asset. So the asset will be going up by 120,000. When the customer walks out, they're going to be walking out with goods that are worth 70,000. So we're going to be reducing our inventory by 70,000. Now let's see what happens on the other side. We have no liabilities here. In our equity section, we're not going to be dealing with paid-in capital. Instead, we're going to be dealing with the retained earnings side of equity. The sale of 120,000 represents revenue, sales revenue. The reduction in inventory represents the cost of the inventory that is matched to the revenue. So we're going to recognize an expense equal to the reduction in the inventory. We're going to come back later and put in the account names, but right now the effect on our accounting equation is an increase in assets, an increase in retained earnings through revenue, a decrease in inventory, and the recognition of an expense. Well, these net out to 50,000 on each side of the accounting equation. The next transaction says that we paid the rent for our warehouse, and that was $5,000, which represents a decrease in assets and a decrease in our retained earnings. But why am I showing expenses if they're going up? If rent expense is going up by $5,000, why is it represented as a negative amount in the transactional analysis? Well, because it's reducing down equity. Expenses reduce retained earnings. Revenues increase retained earnings. Expenses reduce down retained earnings. Next, we're going to make a payment for an insurance policy that is not going to take effect yet. The money is gone. We paid $6,000 in cash, so we have to show that. But at this point, we do not have a cost because we cannot match it to any revenue because the policy begins in April. So this is known as a prepayment or a deferral. And we're going to do that by recognizing a temporary asset for this prepayment. So we'll have a trade-off of assets here. Cash goes down, this prepayment will go up. Next, we're going to pay for some of the merchandise we earlier purchased. We're going to make a payment of $70,000. So our cash will go down, as will our liabilities. Well, earlier we made some credit sales, and now our customers are going to pay us, so we'll be receiving $55,000 in cash, which means we are trading in that intangible asset from the credit sale to a tangible asset, cash. So these two will cancel each other out and our accounting equation remains in balance. And finally, we're going to have some depreciation expense. When we purchased this equipment, we did not call it an expense. Instead, we increased an asset account equipment by its cost. Through a allocation process known as depreciation, we are going to match the cost of the equipment to the revenue it helps generate. So the net effect on our asset is going to be a reduction of 1,000, and we're going to have the recognition of our depreciation expense, which again will reduce down retained earnings. So now at the end of the period, we can sum up our categories. Get the total of our assets, our liabilities, our revenue, and expenses. So now that we have our totals, our assets are $395,000. If we add up the right side of the equation, the liabilities, paid in capital, retained earnings, we have 394, and we have balanced our transactions. Now, of course, we're going to go through and assign accounts to each of these. I'm going to leave that to you because that's going to tie in with our next topic, the bookkeeping function. So if you're following along, download the worksheet that's available on the portal. Try working through the demonstration problem first and then coming back to the video to check your answer against what we have displayed here.